You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey everyone, welcome back to another episode of Market Champions. Today we've got Daniel Wan, the founder of Prerequisite Capital based in Australia. Daniel, thank you so much for being on the podcast. It is amazing to have you here. I'm really excited to talk to you.
Yeah, nice to join you.
Yep, we're going through some interesting times, so it's awesome to get the opportunity to speak to you. So, Daniel, could you just share a bit about your background, how you got into finance, and sort of your journey to starting Prerequisite Capital?
Yeah, so the really short version is something like 20 years ago, was quite interested in how the world worked, markets, all of this sort of thing. Wanted to get straight into some sort of an investment firm or something out of high school, but couldn't. Went into accounting, started into university. Pretty quick into university, I realized or at least this is what I thought back then, somewhat naively, that I could do a better job educating myself than what the university could. So I fired the university, became a hermit, spent a few years, with another box of books, rocking up on the doorstep every few weeks. Had to get back into the real world again. Long story short, I found there was a global macro hedge fund, not too far away from where I was. Pretty much just called them up out of the blue and asked to speak to the guy that was running it. Just said, look, you don't know me. I'd love to be doing what you're doing in 10 years time. Can I buy you lunch, etc. He then, we caught up for breakfast and one thing led to another, and I became an analyst at that fund. And then everything sort of dominoed from there. And before you know it, we went through the financial crisis and different things. Met some of my now business partners. We had a fairly common sort of view of the world, common set of values, all of this sort of thing, and kicked off Prerequisite about 9 years ago, roughly. And now we basically provide research, and also we run very conservative, sort of resilient investment portfolio mandates. Mostly the money that we run is here in Australia, and most of our research clients are actually around the world. But it's the same sort of engine of research and insight that feeds everything we do. And so that's the short version of how I got here, so to speak.
That's awesome. And, the fact that, you just called a global macro hedge fund in Australia and, just got a job for them, I think that is amazing. So, I guess the number one thing that everyone's thinking through is this whole Russia-Ukraine situation. So, how are you thinking about it, both from a geopolitical standpoint, as well as, the market dynamics that, the way the situation progresses implies?
Yeah, so we've been watching leading indicators of growth and inflation deteriorate for the better part of last year. And now this year, and at the end of last year, depending on how you define a coincident indicator and data sets of growth and inflation, but particularly growth has been sort of decelerating for a little while now, even ahead of coming into all of this turmoil this year. And even, for quite a while now, or the last several quarters, we've seen accelerating capital flows into particularly the US, and it's a fairly consistent story. Capital out of China, for example, kicked off fairly early last year. And then more recently, at the turn of this year, we started to see money moving into Switzerland, which usually sort of makes you sit up and pay attention, especially with geopolitical sort of dynamics escalating. Some of our leading indicators on geopolitical risk that is or isn't priced into capital markets in the world, the leading indicators were anticipating escalating geopolitical risk this year. And so we'd kind of been observing that, and also the fact that there was almost no risk priced into markets, relatively speaking, relative to history in capital markets last year. So we're coming off cyclical lows. And so that set the backdrop. And so now that things have actually started to manifest and, everything's unfolding as it is, what that's basically done, or the fastest way to understand what that's doing right now is it's causing a supply shock that is actually destroying demand through price, right? And so having, for example, the most clear-cut example is just the price of oil, escalating as high as it has, as fast as it has. That's effectively like a massive tax hike out of the blue for the global economy that was already weakening, basically. Or it's the equivalent of having central banks increasing interest rates by a massively significant margin out of the blue. And so that sort of thing is just fast tracking a bit of a destruction in demand, basically, initially through price. The problem is that we're seeing liquidity was already starting to wane coming into this year in markets, and positioning was fairly excessive in a lot of different markets as well, particularly in equities. And so we were kind of vulnerable as it was, and then as it all started to unfold, then that's just added further stress. We still have huge liquidity problems in the world right now, and that seems to be getting worse. We're starting to see credit risk really starting to be priced in with all the sanctions that are unfolding, and effectively a sanctions war starting to gather pace. Will escalate in a really big way. That's just fast tracking all of these dynamics, which are very negative for growth and demand, obviously. And past the point, what we're actually seeing is early signs of a potential deflationary shock. Because of the credit risk that's escalating, we've got increased risks of stranded capital around the world. In the months to come, we have increased risks, especially because we're already coming into a decelerating growth environment. Increased risks of miscalculation in the system being discovered or revealed. And that's usually where things get fun from a market perspective. And so we're also an environment where, volatility in bond markets and even currency markets has been escalating in such a rapid manner. Obviously, we've seen the volatility explosion in commodity markets, but bond markets or fixed interest markets is where it really matters in the world, and secondarily to that, currency markets, because of the derivatives and the interrelationships between systems that sort of triangulate in those two very big sets of markets. It's highly likely that there's, things are blowing up or have blown up that are yet to come to the surface. We're seeing all of our gauges, conventional and unconventional credit risk in the world and in different regions starting to increase or explode. And in the context of, hemorrhaging liquidity, mistrust, people jumping at shadows, even in anticipation of possible sanctions and knock-on effects, China starting to get a little bit more unsettled, so to speak, especially because they're obviously sitting back and watching all of this unfold and knowing full well that, there are certain scenarios in the months and quarters to come, if things don't de-escalate, that they'll be in the crosshairs as well, or getting tied up in things. And so, for things to be growing and for things to be productively moving forward, and for us to be producing things and cooperating, we need trust out there. And what we have is mistrust and fear, and so unfortunately there seems to be more signs that point towards escalation in geopolitical conflict or confrontation, more signs that point to escalation rather than de-escalation, unfortunately, at the moment. And
Right.
so that acts as a bit of a feedback loop towards more stress and pressure in the globalized system. And having, the reality of the supply shocks sort of forcing through price a destruction in demand. It's quite a precarious sort of
Right.
set of conditions where we're sort of morphing into. And so we have echoes of a lot of different periods of history in different ways. And so, now's the time to be a little bit more cautious than usual and a bit more resilient. And, the flip side of all of this is that it's likely that there'll be, lots of opportunities from a longer term investment point of view, potentially coming down the pipeline in the next several quarters or the next couple of years. And so that's I guess the synopsis, so to speak.
Yeah, and definitely, with that synopsis in mind, I wanted to start digging deeper into some of the themes you were talking about. And so I think the first one that I wanted to discuss was you mentioned liquidity and how there were some liquidity problems that were slowly coming up to the surface. And so when you think about liquidity, so how do you actually define liquidity? And would you watch for, I mean, obviously you don't have to share like the specifics, but what do you watch for to analyze where liquidity is headed, or where liquidity conditions are going? And
so liquidity means different things depending on what part of the system you're looking at.
Exactly.
So when it comes to markets, normally you're talking about like an order book depth. What is the size and bids and offers and the different depth of stack, and
but it also refers to like the Fed and the central banks coming in.
So then liquidity, you can sort of step back a little bit more broadly and define it as purchasing power, or the ability to gain credit even, and funding towards things. Because the problem with studying liquidity as a concept is that you kind of can't define it. Like if you narrow down your your field of reference, say just to markets, for example, well, maybe you can start to define it in terms of the order book depth, for example. But then as soon as you start to step back and step out and take a broader view of the system that we're in, liquidity or money or credit or purchasing power takes a variety of different forms, and it actually can come into existence and out of existence in such a multitude of different ways. It's kind of ridiculous, and when, depending on how broad you define that, especially at the broadest possible level in the system, the central banks of the world actually are net contributors. Like their contribution to that broader pool of liquidity, more broadly defined, is actually quite small still, and the sources of liquidity, where liquidity can come from, and also how it can be sidelined or destroyed, are far more varied and multiple. They just go way beyond just the central banks in the first instance. And so even trying to define it is problematic, and different people like Jeff Snyder will point out that the central banking community can't even define money anymore, or you start to talk in terms of money supply, and like, well, what does that even mean anymore? And for decades now, you really have to take a broader view of these things to sort of wrap your head around it. And so the other problem too, it's a little bit like trying to track capital flows in the world, right? It's not like you can bring up a ticker on Bloomberg and go, oh, the net, capital moving from here to there or into this region. And like, it's just not that simple. And, there's a lot of activity that happens, which in substance is almost like money moving between nations, but in reality is not really well captured in especially more conventional economic type data sets. And you've so the solution is we need to triangulate things, so we can't necessarily see the exact analysis target sometimes, like capital flows between regions even can be kind of tricky to track unless you sit inside or somehow have transparency to pretty much non-public information in banking systems and, central banks and commercial banks and different things. For everyone else, we kind of have to triangulate it. So we can't precisely measure the actual flow, but we can see the effects both from this area and in this area. And we can kind of triangulate around. We know the principles of how, liquidity or, comes into existence, what drives it, the behavioral characteristics, the nature of money and credit, and some of the mechanisms of the banking and currency systems. And so what we basically do is we can see the effects, which then betray what is actually going on in the analysis target. And so we triangulate these things. And it's kind of the same with liquidity, depending on what area you're focusing on. So we have different measures for market specific measures of like underlying liquidity, or in a sense, like order book depth. We also have others that are broader in nature and scope that try to get at the very core of what's going on in a globalized sort of manner. With the globalized central and commercial banking system in aggregate, trying to get a sense for what's going on there. And then there's sort of subsystems, like we have some frameworks for and some tools for the Eurodollar, more Eurodollar specific system. And even there, we've kind of the last 12 to 18 months has been sort of quite abundant sort of liquidity conditions in that sector relative to, say, the last 15 years of history. But even there, we're seeing all of those measures as of this year sort of peaking and showing the early signs of rolling over into tightening liquidity type conditions, even in that system. And so when we survey the world through a variety of different lenses, and we try to make all of these observations more objective using data-driven models and trying to reduce abstract concepts into objective data, so to speak, we can sort of, when you're glimpsing the same sort of underlying phenomenon from a variety of different perspectives that are reliable and unrelated, and you're seeing the same picture emerge, that starts to give you a greater degree of confidence that what you're seeing is actually unfolding. And then if what you're seeing is actually, a core driver of things, everything else should be kind of a symptom of that, which, so far it all appears to be the case. And so, yeah, how do we look at liquidity? How do we think about it? I spent, 10, 15 years running down rabbit holes trying to evolve solutions for that. And many of them are quite practical. None of them are perfect, but when you put them all together, it starts to paint that three-dimensional picture. So the other thing I realized, because liquidity can arise and be destroyed even from so many different sources in the system, when it comes to being able to draw direct line of sight from, say, the banking system does this, that means liquidity does, is doing this. And that means that has this effect on this market, for example, even if it's a major asset class. I find it's not that simple because there's such a variety of moving parts. Like people can just have a shift in preferences, for example, this versus this, and that will cause a tidal wave of liquidity in effect to shift from here to there, right? And that might not actually have anything to do with banking system type derived, changes. And so I tend to find when you're talking about specific markets or asset classes, you really need to drill down to their specific underlying liquidity conditions themselves, because you can't always draw stable conclusions or relationships with banking system inputs or whatever it is. And you do tend to find that underlying liquidity, it will reveal a strong condition or a weak condition under any given market. And when you combine that with positioning information, can be really helpful in identifying periods of risk or continuation of trend or change of trend potentials and all of this sort of thing. So yeah, I don't know whether we've gone too far afield from
I think that was fantastic. No, I think it was fantastic. But one thing that you did talk about was how we can use data to arrive at these conclusions. And so, to take a broader approach to that, another concept that you mentioned was looking at parallels to cycles of history. And so, what we're going through right now, what is the closest parallel to history that you're seeing? And, you've heard my mentor, Mike Green, talk about the similarities with the Roman Empire. And, just wanted to get your thoughts on the cycles of history that, the what we're going through, how that's similar to various cycles of history, and where you're looking.
Yeah, well, like the old saying goes, history never repeats, but it rhymes.
Right.
And this is the thing, there's such a multitude of potential parallels, both in a financial sense and in a geopolitical sense, to so many different periods. The only exception is that we are the issues we're dealing with right now is so globalized in scope, and we have this backdrop from an economic financial perspective that is more globalized than we'd ever really experienced in history. Normally, up until the last 50 years, there's still been some form of detached, discrete systems that cobble together to form the world. The last 20 years, we've become so integrated, interconnected, and interdependent, and everywhere basically has gone through this credit cycle like we've never really seen in history, especially on a unified, globalized basis, that we have a backdrop that doesn't really have precedent in history, not in that globalized sense. Unfortunately, in terms of like lessons and principles and patternings of history, or precedents, we seem to be ticking a lot of the wrong boxes at the moment in terms of where the world might be headed in terms of geopolitical escalation and conflict. And unfortunately there's parallels to the lead up to World War One. There's parallels to a variety of different fairly major confrontations. Hopefully the dominoes don't keep falling in those directions. We get something to short circuit these different dynamics. Having the weight of an untenable economic backdrop, unfortunately, adds inertia to more problematic outcomes over the next 10 years, for example. But if we weren't so, pushed to such extremes from an economic context point of view, then maybe we don't go, as far down an unstable pathway is what we might be. So yeah, unfortunately, it's very easy to see scenarios that are not fantastic for the world, and this competitive landscape that we're observing, I think, is only going to get more competitive because there's too many systems, societies, nations that are just between a rock and a hard place in terms of all of their excesses catching up with them, and because it's very hard. And at the same time, we've got policymakers and politicians everywhere disengaging market mechanisms or dampening market mechanisms and eroding the rule of law that we kind of need to underpin trust and predictability and reliability in our system. That when you start to play games with those things, we make our system less productive, and we actually pressure our living standards. So living standards rise when we're producing more and more abundance of useful goods and services in the world. But when we start to suppress or disengage market mechanisms, and when we sort of deteriorate the quality, predictability, reliability, and even the fairness of the rule of law, that strikes straight to the heart of living standards, because we just can't produce in the way we can. We can't invest in the way we can. Markets don't function to kind of keep the system healthy and clean, and allocating resources where they need to go, rewarding good stewardship and penalizing poor stewardship, et cetera, and helping keeping the system healthy and moving forward and productive, and ultimately raising living standards and having a fair and just, legal system. Anyway, so in white-anting those things, we're basically almost guaranteeing increased pressures towards decreasing living standards everywhere, right? And when I say everywhere, I mean like in most places that kind of matter in the world, in terms of that aggregate trajectory. And so decreasing living standards, pressures towards, productivity problems. And when you disengage market mechanisms or dampen or disempower, when markets are unable to solve problems in the system, then you start to have to escalate to political solutions or political systems to solve problems. And if that political system is a little bit gridlocked or dysfunctional or whatever, then that escalates to another level of problem solving that's more akin to, toddlers in bad moods, and conflict escalates in not good ways. And so hopefully we don't keep heading down that path. But unfortunately, the solution to all of our problems is actually to double down on what's causing the longer run problems anyway, in disengaging market mechanisms and creating more arbitrary rule of law and et cetera, et cetera. So, best to be a little bit more resilient moving forward, upskill so you can adapt and take advantage of the opportunities that unfortunately, anyway, it's just a fascinating world. And so the parallels with history, like your original question, are, suggesting problematic times ahead unless we can somehow stop these dominoes falling, or these feedback loops from self-reinforcing. And right now, I can't see what's going to short circuit these things just yet,
As you laid out initially as well, when geopolitics as a whole has been a muted theme throughout the last decade, and going forward it seems to be becoming increasingly more important. And number two, as you mentioned, the rule of law across some of the major countries starts to go down, living standards start to go down. And so within this, I guess, framework of thinking, how would you go about implementing this into a portfolio as an investor?
Yeah, so just trying to think how we talk through this in the time frame. But so most people are trained to think in terms of valuation, right? And in fact, 20 years ago, even 10 years ago, the conventional accepted wisdom, especially in even more elite type investment circles, was that geopolitics doesn't matter, right? Because we've had a period of time for the last 40 years, up until maybe the last 5 years, where you can be very successful in markets and investing, ignoring geopolitical realities, right? And get away with it. And so we've got this, like I used to meet up with all these sort of older, more successful guys, and they'd explain to me why geopolitics just doesn't matter, et cetera, et cetera. And you hear it. In the last 5 years has been a bit of a wake up call to all of them that actually it does. And all of these different things are going to play even more outsized importance than people realize. Now, when we're early on in our investment journey, normally we're learning about valuation concepts, right? Either of specific companies or assets or asset classes or whatever. But valuation concepts inherently, especially the way you then outwork them in an investment portfolio, they have this implicit assumption or some sort of a mean reverting mechanism that's required to make it work. So when some asset is undervalued or an asset class is undervalued, you're supposed to allocate into that, and then inevitably, it'll somehow mean revert, and that's where you make your money. And when it gets overvalued, well, you start to, shy away from it, and et cetera, et cetera. That's fantastic. And you do need to educate yourself into all of that. But that assumes that we have functioning market mechanisms, right? That will force mean reversion, that can actually cause all of this to actually function. And over the last 50 years, we've also had a backdrop of the world coming together, more or less, that globalization type thing. Functionally, we've had a bit of a rule of law intact, for the better part of 50 years, increasingly globally even. And so capital can freely move, and there's mechanisms in place to be able to be confident that it'll be safe and secure and all of this sort of thing. And then on top of it, there's been demographic tailwinds, especially, over this broader period of time, which are now starting to turn into headwinds. But we also had huge tailwinds in terms of a credit cycle, like a multi-decade generational credit cycle in the globalized world, like we've just never seen before. So any hiccup, any stumble or natural cycle in growth, that is a buy opportunity, because you got all these tailwinds that naturally mean revert it back to a trend level of growth, or even higher, because we've got this tailwind of credit creation and risk assumption and a cooperative international environment, and new markets opening up, and it's just all positive, trust basically prevailing in the world, more or less. Now we have basically the exact opposite, where we've got credit saturation by most different measures, and every new dollar of money or liquidity or credit that's created in all its different forms is producing less and less productive output or result. So we've got credit saturation on the one hand, very fragile, over-indebted system, to like heavily concentrated sort of system and power substructures as well. It's not a very diverse and resilient type footprint of a globalized economic system we have in the world. Potentially, we've got demographic headwinds in a lot of major countries. And we've also promised more than we can ever deliver on as societies, and so our future liabilities well exceed our capacity to actually produce and deliver on them. And so we've got a lot of problems and untenable excesses that are kind of coming to the forefront. So in that sort of world, we can't really go back to a valuation investment paradigm. We still pay attention to it as a bit of context on different things, but what's really going to matter is how the system actually adapts, right? And so it's more a case of you need frameworks that are more geared to following the money. Because there's going to be, in trying to wrestle with all of these things, and desperate policymakers that are getting more extreme, every year or every few years, they come up with more and more extreme type versions of what they do to try and stay in control. And that's going to cause more and more disorientated capital in the world, especially in the broader conditions that we've morphed into in recent months or escalated into. And so sometimes it will make sense why money is moving in particular ways in the world, or into some markets and away from others. But sometimes it won't. And, the world is not a perfectly rational place, but there's a functional logic to it, right? More often than not. And so when you're seeing money moving in a consistent way, or these capital flows in particular ways that might not at first glance make sense, it seems a bit counterintuitive. When you sit back and go, well, why would there be this behavior in this system? What's the functional dynamic that's driving this and causing this adaptation, so to speak? And then you can start to really understand the system in a deeper level. And then at the same time, instead of analyzing like the shares of Apple as if it's the stock of a company, let's start analyzing it as if it was a currency, like the Japanese yen. And so when you analyze a currency, you're analyzing flows, you're analyzing sentiment, positioning, right? And different dynamics like that, because that's becoming more important. When those flows are healthy, you really want to own that currency. When the flows start to get extreme, positioning's extreme, and different dynamics are starting to turn or become unhealthy beneath the surface, that's where your warning signs are, and you start to need to get out, because that flow or that trending dynamic is probably starting to become quite unhealthy, and so it's learning to follow the money a lot more is becoming an increasingly more important aspect of, say, an investor's toolbox, than a lot of the older ways. And even the way most people are trained, like in economics, for example, is some form of equilibrium type thinking, right? But even there, in the conventional economic sort of paradigms, are more optimized and hyper attuned to conditions that we've experienced for the last 60, 70 years, right? Not the ones that we're in and going into, right? And so we need more of a systems-based understanding of how the world works, like the world is an ecological sort of adaptive system. And we need to be more tune to, well, where is the money actually moving? How's the money moving? Where's the flows going to? What's it concentrating into, and why, and where not? And when do those flows start to weaken, or the liquidity conditions becoming problematic in certain markets, which might suggest the beginnings of a potential change in the way money moves, and therefore a change in trend of those different markets? You know what I mean? And even the old school sort of leading indicators of growth and inflation, for example, still useful, and you still want to have them in your toolbox. But if we're getting into more of a disaggregated type world instead of more challenging conditions, even they start to fade a little bit in prominence, you know, because you've got so many different cross currents starting to occur. And so your lens needs to be a little bit more focused on following the money, basically, capital flows, and you know, looking more and more at, you know, stocks or even commodities, or through more of a currency type analytic lens, or at least adding that sort of a framework to your toolbox as well, to be able to sort of make sense of what's happening, identify risk, and you know, identify opportunities, etc. And so that's the direction to a solution, right? But at the same time, the problem with that is that it's not like you can just pull up a Bloomberg ticker on, you know, XYZ flows or liquidity conditions under any given market, or, you know what I mean? So there's a variety of work that you need to do to start to evolve practical and useful solutions to those sorts of problems, right? Which, you know, for the like 20 years ago, when I started to get interested in the world, and, you know, I'm learning about history and credit cycles in the past, and then I'm waking up and going, uh-oh, I'm coming into my time as a potential investment manager in the future, when we've probably got the mother of all, you know, credit cycles in history. And it was quite extreme back then, and we're now 20 years later, and it's just bonkers, right? You know, how do you navigate an environment on the other side, or in a credit saturated environment that is prone to all sorts of problems because things have just gone too extreme, you know? And even poor behavior is rewarded, you know? So for the last 15, 20 years, the key message that the way the system is operated, and even policymakers have engendered this, is that if you leverage up to the hilt, whether it's in property or in pick a market or whatever, then you're going to actually get massively rewarded, right? But if you be somewhat prudent and, you know, wise, according to old school wisdom principles, where you're making time a friend as opposed to an enemy, and you're not necessarily just leveraging to the hilt and buying every dip, you know, in pick an asset class, you're going to be left behind, punished, and even completely, you know, you're not going to have a business, you're not going to have a job, or you know what I mean?
Yeah.
And so even the incentives towards rewarding foolishness and in wisdom, for example, at least relative to all of historic experience, have flipped on its head, right? And so, you know, we've got a bit of a sick system. And you can argue that we always have different versions of sick systems, but we've actually had, you know, relative to history, an amazingly bullish set of different factors coming into creating an amazingly, or at least what appears to be a very prosperous 50 years, you know, leading up to, you know, the turn of this century, or even up till now in a way. But where the bill is catching up, you know, and potentially, you know, just leveraging up and buying every single dip in everything that moves is potentially about to not be rewarded anymore, because all of those confluence of tailwinds that have supported that sort of behavior, and then the policy that's incentivized it even further, is starting to become, you know, excessively saturated in effect, and inability to act. And so the only solution there is to start to focus more on analyzing, defining, and then following the money, and trying to be able to identify healthy conditions, unhealthy conditions under any given market or asset class or region, and learn how to see the telltale signs of excesses, or, you know, weakening underpinnings to those capital flows and movements, and taking a systems perspective to really being able to triangulate, well, why is this money behaving in this particular manner? To get a broader understanding of the functional logic of how things are happening, so you can be better placed to recognize change when it's happening, when it's significant moving forward. And these are, in some ways it sounds like common sense, but they're actually very profoundly different paradigms to how most people are trained or brought up in this world, especially if you've gone through a conventional education or institutional setting or system. But yeah, I'm sure someone has better solutions to all of this. These are just my least bad approaches to trying to wrestle with all of these things,
Yeah. Yeah, no, that makes sense. And one thing that that does differentiate your process from, I guess, a conventional manager, as you mentioned, is applying ideas of complex systems and systems thinking into your investment framework. And so, to that end, what are some reference sources or books or materials or resources that you would recommend studying in order to build such a framework? I'm guessing the first go-to is going to be like Jay Forrester's books, but what are your favorite reads when it comes to systems thinking?
So there's 3 books I suggest people start out with. The first 2 kind of teach you how to think in more stable system environments, right? And they're actually written as novels. They're more business books. They're quite simple, but they all, anyway, they're quite profound. Everyone I've ever recommended them to have been grateful for actually taking the time to read them, because they apply to not more situations in life than just what we're talking about. So they're both written by a man called Eli Goldratt. And the first book is called The Goal. And the second book, the sequel to that, is called It's Not Luck. Right. The first book is quite profound and introduces you to a lot of very important principles and concepts. The second book is really paradigm shifting, because it starts to teach you how to analyze complex situations, problem solve in complex environments, systematically engineer breakthrough solutions in complex environments, basically. Teaches you how to think, really. And so those 2 books on the one hand. The third book might even be out of print, but you can usually get it secondhand. I don't know, I haven't looked recently, but in terms of a really simple book with a lot of analogy that people can understand and some practical principles that can be applied to many other areas of life, it's actually a business book. It's called Surfing the Edge of Chaos. It was probably published like 20 years ago or something, and it's written by a group of people. The first author off the list is Pascal, Pascale, and a variety of others. Really simple read book, easy to understand business book, but it introduces you to the concept of emergence, right? And chaos, chaotic systems, complex systems, some of the difference in how you lead organizations through different circumstances and some key principles. And so that's a great crash course on that whole concept of emergent phenomena and how things evolve and adapt. Put those 3 books together, and that's like perfect grounding and launching point, for starting to head down this pathway. And just reading those 3 books alone, that'll be an ace up your sleeve in whatever business you walk into or career path you go into. They're really quite profound in some of the things that they teach and instruct you on. But once you read them, you know what I mean by that. But that's probably the best beginning, and they're actually very easy to read because they're both kind of, especially the Goldratt ones, they're literally written as novels. They're not written as textbooks, but they're teaching novels basically.
Yeah. And so, I guess on the flip side of this, what sort of quantitative or technical skill set would you need to build in order to apply such a framework? Simply because when you think of chaos theory, it's very easy to jump into some advanced physics.
Yeah. Well, the good thing about all of this is, well, good thing, bad thing, and what I'm about to say might be my perspective birthed out of my own limitations, right? Now, one of the first things my dad's an engineer, 2 + 2 in his world always equals 4, right? Because you don't have thinking participants as key variables in his systems that he needs to engineer within. If you build a bridge, whatever, the natural laws of physics and science and whatever prevail. 2 + 2 always equals 4. You can pretty much build a bridge with all of those natural laws that are constant. As soon as you bring in thinking participants, right, 2 + 2, most of the time it will equal 4. But, sometimes it'll equal 6. And other times, in other contexts and other system structures, it'll equal -3. Right. And so when you introduce thinking participants, there's
Reflexivity, as Soros has talked about, right?
Yeah. So on the one hand, so from a maths perspective, it gets so complex that even the most complex super quantum computers just are not going to be able to handle it. Right. On the other hand, it kind of makes it so simple because like people are just not mathematically driven beings. Right. They're behaviorally driven, right? And so you need to understand what drives people, and even studying things like leadership and psychology and things like that will be more useful to you than the complexities of maths. Now, having said this is where, and so in all of my studying of people and societies and histories and markets and banking systems and the way all of that works, and data especially, the most profound things are usually the most simple, and normally they're so simple that I would never have deductively figured them out, only that I just stumbled across them trying to do something else and going, oh, stuff me, that's actually what unlocks this, but there's a counterintuitive dynamic that kind of causes, like, you just won't deductively figure it out. It's like you've got to pursue a deductive understanding of the world at the same time as an inductive sort of systems analysis type way of approaching it, and then working to reconcile them. One of the things we learn from natural systems is there's no such thing as complexity, or there's no contradiction, right? As soon as you think you see contradiction, all that means is you just don't understand that system or that reality well enough, right? And that applies in all things, I find. Especially in understanding the world. And so if you start to identify contradiction in your own thinking or analysis or people or in the world or what's happening, it just means slow down. They're not crazy, or it's not crazy, even though it appears like that, or it's not actually, like, contradiction doesn't exist in reality, right? Just a misunderstanding about reality tends to be the recurrent lesson. And so that just is a red flag to have to dig deeper. And so by taking all of that very seriously, the other thing you realize is that, Dad's an engineer, I've known lots of programmers, I've known all sorts of different people, scientists, different walks of life, some amazingly smart people out there, right? And if you're running a business or you're managing a team, half the time you're going to have skill sets in your team that are way beyond your intellectual, or you're just not trained in those spheres, right? You're not an aeronautical engineer, you're not an advanced programmer, you're not a whatever. But can you still lead that team? Absolutely, you can. And what's the common denominator in every single transaction that occurs in this world, which is basically, when we're studying markets and economics, we're really studying transactions and behavior and all of this, but the common denominator always is people, right? And so you can develop an edge in any situation if you understand the people denominator better than most, right? So I have tended to drive into that heavily. And so if you can walk into a room like with 3 engineers, right, you might not have a clue about, they may as well be talking Chinese, right? But what you can do is go, this guy's full of pride, this guy's insecure, he's actually he's lying about whatever. This guy's pretty legit, this guy's humble, that has all the hallmarks of sincerity. And when he talks, like, you can see who's full of it, who's not, who you should be listening to, who's capable, who's not. and then you can double check it with some others anyway. But your key to unlocking that is in the people, understanding people and behavior and psychology. And it's the same in markets, and it's the same in what drives money and movement of money. And because, the whole point of a market or economic system is to basically solve problems so we can all live and thrive, basically, in different expressions of what that means, and so getting too heavy with maths is actually going to stuff you up, I would suggest. Having said that, taking some of the behavioral lessons you learn and then going to an advanced computer programming person and saying to him or her, hey, here's the concept and here's what I understand about how this roughly works. Can you go and take all of this data, model it and do this and that? And, they'll probably come up with a much better solution, but they never would have seen it in themselves because they don't have this broader view. You know what I mean? And so
it is very useful.
Where I sit and what I do and what I see as effective, you don't really need anything beyond primary school maths, right? Or maybe middle school, early high school maths. Like you just don't need to be that complicated. And if you really need anything more advanced than that to understand the world, look, I don't know, but at the same time, so I don't know whether I'm talking out of my limitations of not being, having spent a lot of time going into advanced maths and this and that and whatever.
Yeah.
But the solutions I've arrived at are very much behavioral, psychological, people-driven, societal-driven, an individual, everything about a person says something about them, right? And you can triangulate a lot, and the same principle, but it gets even easier when you starting to talk about groups of people, right? They become much more, unfortunately, a little bit more primal in a sense when they start to aggregate. And IQ usually goes out the window past the point, and and so just it becomes really ridiculous. You're just watching the pendulum swing of emotion going from one extreme to the other, when you get a big enough group. And because mood can define so much, your mood will define how you perceive things. So if some event happens in the world, but you're in a bad mood, you'll perceive that negatively, and then you'll price that and act off that negative in a market. If your mood is really optimistic, you can take on the world, do anything, whatever, positive, something happens, the same event, even if it's the most negative thing in the world, you'll still see it through a positive perception or positive lens. So it's the perception that's more important than the actual event. So it's not the event in itself, it's the perception of the event that has the greater impact, especially when you're talking about markets and societies and how the world works and what actually drives behavior and et cetera, et cetera. Anyway, I don't know whether,
Yeah, that did answer my question.
Simple questions. I don't know. They don't really have many simple answers, unfortunately. I wish they did.
No, it's a very interesting framework. And, previously you discussed looking through individual stocks like Apple through the lens of the way you would analyze the currency. And so could you also explain, just with, other examples, how would you take the understanding of the systems thinking framework and directly apply it to trading or investing? Could you sort of give an example of how you would do that?
So, well, I've spent 15 years trying to evolve those tools and frameworks.
You have a lot of examples. I'm kidding.
Well, yes. Now, how do you do that starting from scratch? Well,
but just as an example, could you give an example of how you started off with the systems thinking framework and arrived at a trade idea?
Yeah. Well, so that evolved over 20 years, but I also was fortunate enough to have a mentor in that space who's just world class in that complex systems analysis and problem solving framework. The only thing is he never applied it to global markets or economies. He more applied it to logistics, supply chain systems, or businesses and all of this sort of thing. I mean, my quarterly letters that I post on the website under managed portfolios, we've got quarterly letters going back years. Like, all they are examples of this sort of stuff. So how we apply flows and liquidity analysis or systems type thinking principles has a bit of a undercurrent. The problem with systems thinking is that it's not easy to capture in a conversation or even in print. Like, it's a whole, we've got to train you into principles and then a whole world of how this actually applies, starting with smaller, simpler things and getting into more, multitudinous, dynamics. And so as a result, I tend to actually avoid talking about systems quite a lot, especially even in the research. And in a sense, I'm trying to describe a complex system with a lot of interrelationship, feedback loops, interdependencies, all of this sort of stuff in a very linear, word-driven report. Like, all of a sudden we got a mismatch here of basically a spaghetti mess diagram and a lot of embedded knowledge and principles and expertise and understanding in that spaghetti mess diagram of interrelationships and what that system is. And you're trying to string that out into a series of words and some charts. There's a mismatch there, and then it's the same in conversation. And when you study those books, if you do, I've suggested, you'll see exactly what I'm talking about, or you'll start to glimpse exactly what I'm talking about. Now, when it comes to underlying liquidity, flows, positioning, different dimensions like that, if you skim through some of our quarterly letters for the last 2 to 3 years, there's just countless examples of all of that and how that applies and all of this sort of thing. So other than like sharing my screen and starting to run through and actually teach and train, I don't know how to do this in probably the space of 5 minutes that we kind of have. But the disadvantage though for me doing this is that I'm giving you, the back end of 15 years of studying this and evolving a lot of different tools and frameworks. And I don't consider them all perfect, but they're definitely in that list of least bad solutions to these hard problems. At the moment, my business partner, like, past the point, I'd probably make it all open source and just knock yourself out, go for it. But yeah, at the moment, I'm still running a business, can't really do the open source routine just yet. But yeah, there's no, I don't know what the easy path is. I only know hard pathways.
Yeah, no, it is interesting. And so I guess to wrap up the podcast, now, Daniel, could you just sort of share with investors, what should they be watching as we move through these interesting times? What should they mostly be keeping their eyes
on? Currency markets are probably the most important thing at the moment, because in a world like this, like, a lot of things will start to happen first in currency markets, where you're seeing marginal shifts in how capital is moving and behaving in the world before it really starts to show up. Like, the US dollar has been strengthening for a while now, right? And it couldn't break the previous sort of lows of the last 6 years, for example, even though, we've had crazy fiscal and monetary policy like we've never seen before. We've had this, everything else, like, this, it's the perfect storm for the popular understanding of the US dollar that it should be just toast, right? But yet it couldn't even knock out the lows of the last 6 years. That's a sign of inherent strength at a structural level, even though we don't understand it. Why can't the system move in a way where that gives way? Well, maybe we don't understand something about the system. And a lot of what we don't understand about the system is the monetary and banking system, that causes all this liquidity and all of this sort of stuff, and the Eurodollar components of it all. And what we actually have is a backdrop of an impaired globalized financial system that has kind of been limping along through these sub-cycles of little reflationary growth, but overall it's impaired, right? And more recently, we've been sort of going back through a gust of tightening in that broader system. and so we've been also, that started to manifest in a tightening US dollar against most things, right? And, even at the beginning of the year, all of a sudden we're seeing, like flows into Switzerland, for example, which is a bit of a hallmark of, and they're even recently, the exodus out of Europe has just been very rapid and very pronounced, and so just keeping an eye on currency markets, because they'll tend to look through, anticipate, discount, some of this stuff and the squeezes in different commodities, which can be quite deceiving. Like inflation expectations in bond markets are rallying in sympathy with the commodity price squeezes that we're seeing. But the second, third order effects of what we're seeing in a lot of the world are incredibly deflationary in nature, which is why we're seeing the early signs of a potential deflationary shock brewing as we speak, but everyone's distracted with rising commodity prices and even break-even inflation expectations, and also lagging inflation data sets such as the CPI, for example, that are still all the way up there, and so it's trying to understand the world through a deeper first principles sort of basis, through a bit of a systems lens, thinking about second and third order effects instead of just first order superficiality, but yeah, keeping a bit more of a focus on currency markets would probably keep you in good stead, because what they can signal are shifts in character, like money will move before things happen, usually. And so in these sorts of environments, paying attention to what the currency markets are kind of telling us or not telling us, or confirming or not confirming, can be pretty important to navigating all of this well. But problem is there's no simple answer or way to doing that. Like that can take a bit of experience to form right perspective and understandings. It's not easy. And then even when you have the experience, it's a tough job. Like it's pretty complex out there. I struggle, and I've been obsessively trying to do this for 20 years, and I've got a lot of tricks and techniques, but it's still not easy,
Yeah, absolutely. Well, Daniel, thank you so much for your time. It was awesome having you on the podcast. I learned a lot. I'm definitely going to check out those books that you recommended on systems thinking for sure. And so once again, thank you so much for being on.
Yeah, not a problem.